Greg Parsons, your 5-star rated Semper MBS Total Return Fund is stock full of mortgage-backed securities. It's performed very well this year. What does that performance tell you about the state of the housing market?
You know, performance of our fund is illustrative of the fact that the fundamentals of the U.S. economy, specifically housing, continue to improve. The data suggests continued appreciation of home prices, and as we look down at the underlying drivers of value, right, can people pay their mortgage or not, all the metrics suggest continued improvement in that market.
Have the problems which caused the 2008 financial crisis, the mortgage meltdown, been wrung out of the MBS market?
Specifically on the non-agency, the private label side, where most of the issues existed, the answer is yes, right? Underwriting standards, I mean, frankly, banks have tightened underwriting standards, and more importantly, on the legacy assets that comprise at least the assets in our fund, you now have 10 years plus of data and performance history, right? If someone got a mortgage in 2007 or 2008, irrespective of how they got that mortgage or why they got that mortgage, if they're still paying on that mortgage today, you've got a solid history of data to forecast out their future ability to pay.
And what's the new issuance market like right now? Talk about supply.
So you got to think about the market, two sides of the market. There's the agency market, right? The Fannie and Freddie paper where supply and issuance is robust. We happen to see more value right now on the non-agency, the private label paper, where effectively it's a great backdrop of support, but there isn't effectively any issuance, right? So you've got a dynamic where you have a stranded asset class, you know, approximately $1 trillion of existing paper that was originated back, 2002 to 2008, that is in some element of runoff mode, right? And all things, if you hold demand constant, you cut supply in half, you have a great underpinning of support for price.
And what kind of yields are you expecting in both agency and non-agencies right now?
On the non-agency side, where we see a lot of value, we believe the sector in a properly diversified portfolio can generate loss-adjusted unlevered yields north of 6%. The agency side of the equation, which we are not as excited about from a relative value perspective, yields are 2 to 3%, but you are exposed to much more interest rate risk.
All right, speaking of interest rate risk, talk about how your fund is going to react if and when the Fed finally hikes rates.
So we're excited about our perspective on the fund's performance in that, again, our fund today is primarily a bet on the credit side of the equation, the non-agency portion of the market. The sector, at a sector perspective, has very limited duration, right, kind of sensitivity to rates. And if you believe that the Fed, which is staring at the metrics around the U.S. economy, will raise rates when and if they believe that the economy is strong enough to support it, those same drivers of kind of economic strength, right? Housing, jobs, wages, all translate to improved performance in our underlying collateral and underlying loans.
And you don't own any European mortgages, so I guess a fund like yours would give you some insulation from things abroad, correct?
Correct. This is a very direct play, or it's a direct play on the U.S. The mortgages that we purchase are U.S.-based, and their performance is tied to kind of the U.S. economy.
So I guess we've come a long way since 2008.
Yes, very much so.
All right, well, thanks a lot for coming on and talking about it.
Appreciate the opportunity.
And thank you for watching The Street.